Welcome back to the Profitable Mindset Podcast. Today we're going to get into something that I think a lot of you out there are really going to connect with, and that's investing after you hit 40.
Yeah.
We're going to take apart that whole idea that, oh, I've missed the boat, it's too late to start.
Right.
And really look at how to build wealth in this, really exciting time of life.
Exactly. Yeah, I mean, that's a big myth that investing is just for younger people,
Right.
Your 40s and beyond can be like the perfect time to ramp up your finances.
Now, you've worked with so many people in this age group, helping them be successful with money.
Yes.
Right? What are some of the advantages that they have going for them?
Well, one of the biggest advantages is earning power.
Right.
By this point in your life, you're probably making more than you did before. And that means you can put more into investments.
Yeah, that makes sense.
Yeah.
But it's not just about having more money to invest, is it?
No, not at all. Life experience is huge here.
Yeah.
You've probably been through some career ups and downs, maybe started a family, and you're just more aware of what you need financially and what's important to you.
Makes sense.
All that adds up to making smarter financial decisions.
So how do we use those experiences and that earning power to make a solid investment strategy?
Okay.
Where should someone in their 40s start?
The most important thing, no matter your age, is to really understand where you stand financially right now.
Okay.
Before we even talk stocks, bonds, real estate, we got to do two basic checks.
All right, let's break those down.
First, your net worth. This gives us a snapshot of your whole financial situation. It's just what you own your assets minus what you owe your liabilities.
So like taking inventory of my money.
Exactly. Like if I own my home and have some savings, those are assets.
Right.
My mortgage, credit card debt, those are liabilities.
Okay.
You subtract liabilities from assets, boom, you got your net worth.
Okay.
That's your starting point for any investing plan.
Makes sense.
It tells us how strong you are financially and where we can improve.
So it's not just about how much you make, it's about the big picture of your finances.
Exactly. Now, the second check is just as important.
Okay.
We look at your cash flow. This means tracking where your money's coming from and going.
So basically budgeting, which a lot of people try to avoid.
No, right? But think of it as a map to reach your financial goals.
Okay.
You wouldn't drive across the country without a map, would you?
That's a good point.
Budgeting gives you that clarity for your money. It helps you see where you can free up funds to invest.
I like that analogy. So we know our net worth. We've looked at our cash flow.
Right.
What's next in building our strategy?
Now we set clear financial goals.
Okay.
Not just vague wishes, but solid, achievable targets that'll guide our investments.
Right.
We need to define what you want and when you want it.
You always hear about SMART goals.
I do.
How do those fit into investing?
Well, SMART goals are specific, measurable, achievable, relevant, and time-bound.
Right.
Instead of saying, I want to retire comfortably.
We get specific. For example, we worked with Susan, a teacher who wanted to retire by 65 with $1 million saved. Wow. That's specific, measurable, relevant to her life. Right. To make it achievable and time-bound, we figured out how much she needed to invest each month to hit that target. Okay. Taking into account her risk tolerance and time frame.
So turning a dream into an actual plan with steps you can take.
Exactly. Now, while we're setting goals, we need to address debt.
Right.
Many people hit their 40s still carrying debt, so we got to understand how that affects our strategy.
Should we pay off all debt before investing at all?
Well, it depends. High interest debt, like credit cards, got to be tackled aggressively. Yeah. That interest can eat up any gains you make from investing.
Yeah.
It's like running up a down escalator. You're fighting those charges constantly.
Yeah, that's a good way to put it. So knock out those high interest debts first.
Exactly.
What about other types of debt?
For lower interest debt, like a mortgage, you can often manage payments alongside investing.
It's about finding a balance that works for your situation.
This is all really practical advice. But before we get into specific investment strategies, there's one more thing.
Absolutely.
We need to talk about the unexpected stuff life throws at us.
Right.
That's where an emergency fund comes in.
Yes, it does.
Having 3 to 6 months of living expenses saved up that you can access easily is a safety net.
It is.
It's like a cushion for your finances.
Exactly. An emergency fund lets you handle those surprise expenses without messing up your long-term investments.
Right.
Gives you freedom and peace of mind to stay focused even when things get tough.
That's so important.
It is.
Just having that sense of security.
All right. So now that we've got that solid base, we've assessed our finances, set our goals, and got that safety net.
Right.
Let's get to the exciting part. Building an investment strategy that uses the strengths of starting after 40.
Okay. I love it turning those so-called limitations into advantages.
Exactly.
So tell me, what strengths are we talking about?
Well, think about it. In your 40s, you've got a ton of experience in your career.
Yeah.
You understand risk and reward better,
Uh-huh.
and you're probably more financially stable than you were in your 20s.
That makes sense.
All that sets you up perfectly to make smart investment choices.
So it's not about catching up. It's about being strategic.
Exactly. Now, a good investment strategy at this point has three main parts.
Okay.
First, we got to revisit those SMART goals we talked about.
Right.
Got to make sure they're crystal clear, that we can measure them, and that they fit into your big financial picture.
Okay, so what comes after we've got those goals nailed down?
Then we pick the right investment tools for the job.
Okay.
This means looking at different types of assets and choosing the ones that match your risk tolerance, how long you want to invest, and what you're trying to achieve.
Wow. That sounds like a lot to figure out.
It can be, but we break it down step by step.
Okay, good.
So let's start with stocks.
Right.
They offer the potential for high growth, which can be great for those starting later.
Yeah.
But they also come with higher risk.
So stocks are for people who are okay with a little more ups and downs in their portfolio.
Right. But it's not about being reckless.
Right, of course.
You can invest in individual stocks, mutual funds, or ETFs, which are exchange-traded funds.
I've heard of those.
ETFs let you diversify across a bunch of stocks, which reduces the risk of putting all your money in one company.
Makes sense. So what about people who want things a bit more stable?
For them, bonds are a good choice.
Okay.
They usually have lower returns compared to stocks,
Right.
but they're more predictable and steady, which is really valuable as you get closer to retirement.
So a mix of stocks and bonds gives you that balance of growth, potential, and stability.
Exactly.
Yeah.
And don't forget about real estate.
Oh, yeah.
It's a physical asset
Right.
that's historically been a good hedge against inflation,
Okay.
and it can make you passive income through rental properties.
Real estate always seems like such a big commitment, though.
It can be, but there are easier ways to invest in it, too.
Like what?
REITs, real estate investment trusts.
Okay.
They let you invest in a bunch of properties without the hassle of owning them directly.
So it's more hands-off.
Exactly. Now, if you're new to investing, index funds and ETFs are a great option.
Okay. I've heard those are good for beginners.
They are. They track a specific market index like the S&P 500.
Right.
So you get broad exposure to the market with low fees.
So if I don't know how to pick stocks, an index fund or ETF is a good starting point.
Absolutely. And then we have what are called alternative investments, things like commodities, foreign exchange, cryptocurrencies.
Ooh, crypto. I hear a lot about that these days.
Yeah, these can have high potential returns, but also come with high risk.
So probably not for the faint of heart.
No, generally these are for more seasoned investors who are comfortable with taking on more risk.
Okay, so we've covered stocks, bonds, real estate index funds, ETFs, alternatives.
We have.
That's a lot. How do we decide how much to put in each one?
That's where asset allocation comes in.
Okay, what is that?
It's basically deciding how to spread your investments across those different asset classes based on things like
It's okay.
your risk tolerance, your goals, and how long you want to invest.
It sounds like we're putting together a puzzle, finding the right mix.
That's a great way to put it.
Okay.
A common approach is the 100 minus age rule.
Okay, I've heard of that.
Yeah, you subtract your age from 100, and that's the percentage you put into stocks.
Uh-huh.
The rest goes into bonds and other less risky stuff.
So if I'm 45, I put 55% in stocks, 45% in bonds.
That's the general idea, but you should always adjust it based on your own risk tolerance and goals.
Right.
Someone who's okay with more risk might put more in stocks. Someone closer to retirement might want more in bonds for that stability.
Yeah, that personalization seems key. It's not one size fits all.
Exactly. Now, as we're figuring all this out, we can't forget about managing risk.
Yep. Risk management.
It's not about getting rid of risk completely. That would mean missing out on potential growth.
Right.
It's about minimizing it in a smart way.
Yeah, that makes sense. Risk management can feel kind of scary, especially for new investors.
I know, right?
So what are some good strategies to handle risk?
Diversification is your best friend here.
Okay.
You know that saying, don't put all your eggs in one basket?
Uh-huh.
Same goes for investing. By spreading your money across different types of assets, industries, and even countries, you reduce the impact if one investment goes bad.
So instead of putting all my money in tech, I should spread it out to things like healthcare, energy, international markets.
Exactly. And another key part of risk management is rebalancing.
What's that?
It means checking your portfolio regularly and adjusting it to keep that asset allocation we talked about.
So like if my stocks do really well and now they're a bigger chunk of my portfolio than I planned.
Right.
I would sell some stocks and buy more bonds to rebalance.
Exactly. Rebalancing helps keep your portfolio aligned with your risk tolerance and your long-term goals.
Okay.
It makes sure you're not too exposed to any one asset, especially as the markets change.
I like this proactive approach to risk. It makes investing feel less like a gamble.
Yeah, it's about taking control and making informed adjustments as you go.
Exactly. And remember that emergency fund we talked about provides another layer of protection.
It does.
It's a buffer against those unexpected things, so you can deal with them without touching your long-term investments.
Exactly.
Right. So we've got that solid foundation. We talked about assessments, goals, risk management.
Right.
Now let's get into some advanced tactics to boost those returns and really make that portfolio strong.
Okay, yeah. Building on what we've already covered, we can explore some techniques that can really supercharge your wealth building.
I like it. This is where it gets really interesting. So what are some of these advanced strategies that can take our investing to the next level?
Well, let's start with options trading. Options are powerful tools,
Okay.
They can be used to boost your returns or lower your risk. They give you flexibility and leverage.
Options trading always sounds so intimidating, though, especially if you're not a seasoned investor.
Yep. I know it can seem that way, but think of options like contracts that give you the right but not the obligation to buy or sell something at a set price within a certain time. It's like having a reservation.
Right.
You can use it if you want to, but you don't have to.
So it's about having more control over my investment choices.
Exactly. There are two main types of options, call options and put options.
Okay, what's the difference?
A call option gives you the right to buy an asset. A put option gives you the right to sell it.
And how does that work in practice?
Okay, let's say you think a stock is going to go up.
Okay.
Instead of buying the stock directly, you could buy a call option. If the stock price goes up, your option becomes more valuable and you can sell it for a profit.
Got it.
If the price goes down, you only lose the premium you paid for the option.
So it limits your losses.
Exactly.
Right.
It's a way to potentially make bigger gains while also managing the downside risk.
That makes sense.
Right.
So put options would be the opposite then.
Right. Put options can protect you against losses. If you're worried about a stock going down, you can buy a put option.
Yeah.
If the stock does drop, the value of your put option goes up, offsetting some or all of your losses.
Okay, that's starting to click for me. But it still sounds pretty complex.
It does.
Is options trading something a beginner should even think about?
Options trading really requires a good understanding of the markets.
Okay.
So it's usually not the best choice for someone just starting out.
Right.
But if you're willing to put in the time and learn it, it can be a really valuable tool.
So maybe something to consider down the line as I get more experience. What other advanced strategies are there?
Another big one, especially as you build wealth, is tax optimization.
Okay, that sounds smart. How to do that?
Well, one of the best ways is to use tax advantage accounts like 401k, IRAs, HSAs.
Sure.
These accounts have tax benefits that can really help your returns grow over time.
I've heard of 401ks and IRAs, but what's an HSA?
An HSA or health savings account is a triple tax advantaged account.
Wow, triple.
It's designed for medical expenses.
Okay.
Your contributions are tax deductible, the money grows tax-free, and you can take it out tax-free for qualified medical costs.
So it's like a win-win-win when it comes to taxes.
Exactly. And if you don't need the money for medical stuff, you can withdraw it after 65 for anything you want.
Oh, wow.
You'll just pay taxes on those withdrawals at your normal income tax rate.
That's a lot of flexibility. So what other strategies can we use to optimize our taxes?
Another one is tax loss harvesting.
What is that?
This is where you sell investments that have lost money
Okay.
to offset any gains you've made from other investments.
So you're basically using those losses to lower your overall taxes.
Exactly. It's a smart way to manage your portfolio's tax efficiency, especially when you've had a good year with investments.
This is all so helpful. These advanced strategies give us so much to think about as we manage our portfolios. Any final thoughts for our listeners who are on this wealth building journey after 40?
Remember, building wealth is a marathon, not a sprint.
It is.
Stay focused on your goals, keep learning, and don't be afraid to ask for help when you need it.
That's great advice. And never underestimate the power of time and consistency.
Exactly. The journey might have its ups and downs, but with a solid plan and the right mindset, you can achieve incredible things.
That's so true.
Yeah.
Thank you so much for sharing your expertise with us today.
It was my pleasure.
It's been a really insightful conversation.
I hope it empowers our listeners to take charge of their financial future and build the wealth they deserve.
And to our listeners, thank you for joining us on the Profitable Mindset Podcast. Remember, it's never too late to take control of your finances and create the life you want. We'll be back next week with more actionable advice to help you on your path to financial freedom. Until then, keep learning, keep investing, and keep that profitable mindset strong.